When we talk about a disruption in the Strait of Hormuz, we have all realised over the past few weeks that it goes well beyond an oil price story. In previous conversation with StoneX Director of Global Macro Strategy, Vincent Deluard, we saw that this supply shock feeds directly into inflation while simultaneously weakening growth. So how do central banks navigate that trade-off? To give us some elements of answer, Vincent Deluard is back. Thank you for joining us, Vincent.
Pleasure to be here.
So why is this such a difficult environment for central banks?
I mean, it comes down to the dual mandate that most central banks have, or even if they don't have it, they always look. Even the inflation-focused one also look at the economy, and this is usually a trade-off, right? If you have a high level of inflation, usually unemployment is low, and vice versa. Now, the problem with the supply shock is that it pushes prices higher, and at the same time, it has a negative economic impact. So you're looking at, you're kind of driving a car or something, and one thing tells you to slow, and the other thing tells you to accelerate. The general inclination, at least at the beginning of a supply shock or a commodity shock for most central banks, is to do nothing, which is what we've seen.
So can central banks afford to sort of look through this shock then?
I mean, again, it depends on the duration, and I think right now we have a lot of wait and hope. That seems to be what the market is doing, what central bankers are doing, and even what the administration is doing, what the Iranians are doing. Everybody's kind of hoping that something will end this. I mean, I would argue that this wait and hope actually ensures that nothing happens, because if everybody's waiting, nothing's going to change. So for now, I think it's still good, but as we get more horrible inflation reports, which we will see as the price shock feeds through the energy market, through food prices, through shortages, is going to be harder and harder to just wait it out.
So what determines whether central banks tighten or pause?
Well, again, it's the duration of the shock. Um, my s- my feel is that the pause is going to be longer, uh, because again, the problem when you're a central banker is in a stagflationary shock is whatever you do is going to be the wrong thing. You're going to piss off a bunch of people, right? I mean, if you hike rates at a time when gasoline prices are up and the economy is slowing, you're really going to get the public mad against you at a time when central bankers are under attack. So there's going to be tremendous resistance against doing that. At the same time, given the fiasco we had during COVID and the supply chain crisis, when central bankers kept easing through the biggest inflation wave in 50 years, you can absolutely not cut. So I think the default is going to be do nothing, keep all options on the table, try to throw the stick of rate hike, which is what we've seen already the ECB do. It's like, well, we're not doing it yet, but we're talking about it. Even the Fed, there was a little bit with this kind of hawkish dissent. So that's where we are, and I don't see that change in the very near term.
What are the key tipping points for policy?
It depends which central bank we're talking about. I mean, some central bankers are more constrained by the currency, the value of the currency. If I think about Bank of Japan, you have this very strong 160 yen floor. That's probably the key thing that they're looking at, is the value of the yen. In the US, we're a bit less currency driven. So for the US, it's probably, I would say it's probably expectations. If you start to see expectations get unanchored, that would probably force the Fed to be a bit more hawkish. We are seeing some of that. If you look at consumer expectations of inflation, they picked up quite a bit this year. Now, it's not being confirmed by the swap and the break-even market, so the Fed can still, again, it's kind of a pick and choose, right? You always choose the indicator that supports your bias. Um, And then in Europe, it's really the performance of the economy. This is where we see the downgrade to growth has been already. They already downgraded the growth expectation in the latest um, forecast. And then as we get into the summer, tourism is a huge driver for Europe. So if you see significant economic slowdown, that would be I think what the ECB is looking at.
And what about main central banks? They must have to come up with different responses, as prior to the conflict, they weren't all at the same point in their respective policy cycles. So, yeah.
Yeah. So we had some regions where inflation had more or less come back to target. I mean, that was really the European Central Bank, which um, gave the ECB some comfort at the beginning of the shocks. Like, well, we're in a good place. We can afford to wait. Um, Now, of course, in Europe, the shock to rate has been bigger because of the dependency on the Strait of Hormuz and the lack of domestic energy production. The Fed has kind of tried to play the same line that policy was already neutral, that inflation was already contained. I'm of the view that it was not, that the inflationary ambers were still red, and that adding another shock on top of another shock and another shock really starts to create risk that this inflation is going to be built in wages and in expectations.
And can you walk us through a comparison? Why might Japan be able to look through the shock, but Australia may not, for example?
Um, in the case of Japan, again, I go back to this idea that it's really about the currency. So we had a report 2 weeks ago called the Yen Smile, and it got so the idea with that report, the Yen Smile, was that usually we talk about the dollar smile. That the dollar tends to rally when things are really bad, rally when things are really good. And my view was it was the same for the yen, that we had this floor at 160 where the Bank of Japan would intervene. If the Strait of Hormuz reopened, of course, the yen would soar, including with all the Asian currencies that get so much of their imports from the Straits. But I made the case that Japan was uniquely positioned to kind of survive a long blockade for two reasons. One is the just massive sheer size of their currency reserves. I mean, they have like 10 years of oil consumption just stored in dollar reserves. So plenty of ammo in case they need to defend the currency. And then the second one was this kind of unique quirk of Japan-Iran diplomacy that most people are not aware of, that Japan is considered to be a friendly nation by Iran, because we had a very similar crisis about 75 years ago when the Mossadegh regime got toppled. The British tried to block the Strait of Hormuz already, and it was a Japanese carrier that eventually broke the blockade. So the Japanese had a lot of goodwill from the Iranians. So in my opinion, they were the only ones who would be able to kind of navigate their way through a double blockade because of the historic good relation with the US and Iran at the same time. Now, lucky for me, we published a report, I think, late April, and then 2 days later, the Bank of Japan intervened, spent some 40 billion in FX, and the yen rallied quite beautifully. So, again, different countries have different constraint, different tools. You mentioned Australia. I don't know if that was just a random example. If you wanted me to talk about Australia, the one thing I would say about Australia is that I'm not a big specialist, but a lot of these kind of smaller Anglo-Saxon currencies still had this unsolved inflation problem going into the crisis, which makes them, I would argue, more vulnerable. Again, it depends of where you started, right? If you started with below target inflation, you have inflationary shock. Like China is a good example, right? China was struggling with falling prices, so yeah, the fact that PPI goes up actually may even help them. On the other hand, if you already have an inflation problem, if you had it for 5 years, as is the case in the US and most of the Anglo-Saxon world, it's much harder to get one more hit.
And finally, Vincent, what about emerging markets? Where do they face the greatest constraints?
I mean, for EM, I mean, you have to, of course, first distinguish between the one that are energy exporter and energy importer. I mean, it's a windfall if you're Russia, if you're Kazakhstan, even Brazil to some extent, and that means that you're going to get a lot of demand, and your currency is going to appreciate. The difficulty, of course, are for the really the biggest difficulty for the dual importers of energy and importers of food. Almost the same pattern that we saw during the Ukraine war, where the biggest losers was a country like Egypt, where on top of that you have a big young population, and political stability issues, and it's really ugly. I mean, because for the few tankers that cross the straits then get a bidding war, and the Japanese, the Koreans, the Europeans, I mean, they may not like to have to bid for these barrels, but they can. If you are Sri Lanka or Pakistan or Ethiopia, you really can't get your hand on energy. So the solution, unfortunately, comes from demand destruction, like lines at petrol stations, asking people to work from home. And yeah, we're going to see, we started to see already energy lockdowns. So yeah, you just have to get consumption there. And of course, that, there's this, I forgot who said that, but it's, I think, a very sad quote, but uh, we're always 3 meals away from a revolution, or something to that idea, that once the very fundamental of life start to break down, which is your ability to feed your family or to heat your home, usually you get social and political upheaval after that, like we had seen, for example, when oil prices were very high, in the early 2010s. That's when we had the Arab Spring. So it's, the more this lasts, the more likely it is that we see political trouble in emerging markets.
Well, thank you very much for your insights once again, Vincent. Great to catch up. For more videos like this, please do like and subscribe.